Hi, welcome. Today we will be covering the tech news which sparked an internet. We will be starting with 1. Big tech earnings and AI investments. Microsoft, Alphabet, Google, Amazon, Meta, and Apple are set to report quarterly earnings this week, with investors and analysts focused on whether the ongoing AI boom is sustainable or verging on a bubble. Combined, the major players are investing about $400 billion in AI infrastructure this year. But many questions remain about when these investments will generate meaningful profits. Debt financing by big tech for AI build-out is accelerating, with Meta arranging a $27 billion private financing deal for its largest data center project ever. Cloud divisions, Microsoft Azure, Google Cloud, AWS, are all reporting strong double-digit growth, especially Azure, which likely grew more than 38% last quarter. AI in society and commerce. Channel 4 became the first British broadcaster to debut an AI-generated news presenter, Arti, using generative video and voice. The experiment has sparked debate about automation's impact on journalism and authenticity. Transparency and commerce, allowing users to tap into their deepest knowledge and provide custom itineraries and tips via conversational prompts. Tesla unveiled new advances for its Optimus humanoid robot, further highlighting its push into robotics and automation beyond electric vehicles. Netflix is rolling out more generative AI-powered content tools to improve efficiency and reduce production costs, banking on AI to enhance future storytelling and visual effects. Period. End. Add AI product and company developments. OpenAI formally launched its new Atlas AI browser, which combines web browsing, summarization, and automation with a built-in ChatGPT-like assistant. Seen as a direct challenge to Google Search and Chrome. Samsung introduced the Galaxy XR headset, $1,800, with tight Gemini AI Google integration, targeting both consumer and B2B AR smart glasses markets. Tech and cybersecurity incidents. Millions of WordPress websites were hit by new cyber attacks, prompting renewed focus on website patching and security updates. A major cyber breach at a Dublin airport IT supplier may have impacted millions of airline passengers' data. Microsoft's Patch Tuesday and several zero-day disclosures kept enterprise and cloud customers busy with urgent updates and new device management rules. Alt_P5. Industry deals, startups, and policy a little. Sequoia Capital unveiled $950 million in new early-stage venture funds. And Intel's Q3 results outperforming expectations. Worktrace AI, founded by a former OpenAI product lead, raised $10 million for automated business workflow AI, and Intel's Q3 results outperformed expectations. Aided by a new $8.9 billion government investment and a big NVIDIA collaboration. 6. Stock market and global macroeconomics, reflecting optimism over a possible US-China trade truce and anticipation for big tech earnings. Investors are cautious about a tech bubble, but growth expectations remain strong. Big tech earnings week, the $400 billion AI gamble. As Microsoft Corporation, Alphabet Inc., Amazon.com Inc., Meta Platforms Inc., and Apple Inc. prepare to report quarterly earnings this week, investors and analysts face a pivotal moment in assessing whether the ongoing artificial intelligence boom represents sustainable growth or the early stages of a dangerous bubble. With the 5 tech giants collectively investing approximately $400 billion in AI infrastructure during 2025, a staggering 57% increase from $245 billion in 2024. The stakes have never been higher for demonstrating that these massive capital expenditures will translate into meaningful profits. The market's enthusiasm for AI has propelled these companies to extraordinary valuations. Microsoft stands at a $3.97 trillion market capitalization, Apple at $3.95 trillion, and Alphabet at $3.21 trillion. Together, the Magnificent Seven tech stocks now account for more than 1/3 of the S&P 500's total value, trading at an average price-to-earnings ratio of approximately 70 times their earnings. This concentration raises fundamental questions about market resilience and the sustainability of current valuations, particularly as earnings growth rates are projected to moderate from recent highs. This chart compares the massive year-over-year increase in AI infrastructure spending by major tech companies, with combined investments rising from $245 billion in 2024 to nearly $386 billion in 2025. The infrastructure investment arms race, unprecedented capital deployment. The scale of big tech's AI infrastructure build-out is historically unprecedented. Microsoft has announced plans to spend approximately $88.7 billion in fiscal 2025, up 53% from the prior year, with much of this directed toward AI-enabled data centers and Azure cloud expansion. Meta has raised its 2025 capital expenditure guidance to a range of $66 to $72 billion, representing a nearly 70% year-over-year increase at the midpoint, as the company aggressively pursues opportunities to bring additional AI capacity online. Amazon is projected to invest approximately $118 billion in 2025, with a significant portion allocated to AWS infrastructure expansion and custom AI chips like Trainium. Alphabet has increased its 2025 spending target to $85 billion, up from an earlier projection of $75 billion, to support strong demand for cloud products and AI services. Even Apple, which has been comparatively conservative in AI infrastructure spending, is allocating approximately $25 billion, though this represents only a 9% increase year over year. These investments are transforming the fundamental economics of the technology sector. From May 2020 to the second quarter of 2025, data center infrastructure spending surged from $9.5 billion to $40.4 billion, a more than four-fold increase driven primarily by AI and cloud computing demands. This capital-intensive build-out marks a dramatic shift from the historically asset-light business models that characterized big tech's profitability in previous decades. The demand-supply tension. The hyperscalers face a peculiar challenge. Demand for AI computing capacity significantly outpaces available supply. AWS reported a $195 billion backlog of committed customer spending, representing services the company cannot yet deliver due to capacity constraints. Microsoft Azure has faced similar supply limitations, which paradoxically serve as indicators of robust underlying demand rather than weakness. Cloud service providers saw global enterprise spending reach $99 billion in the second quarter of 2025, representing an increase of over $20 billion year over year. Generative AI-specific cloud services grew at rates of 140 to 180% during this period, significantly outpacing the broader portfolio's already impressive 25% annual growth rate. This explosive demand validates the infrastructure investments, but also highlights the risk of overcapacity once the build-out catches up to current demand levels. AWS maintains its dominant position in cloud infrastructure with 30% market share, while Microsoft Azure and Google Cloud hold 20% and 13% respectively, with the Big Three collectively controlling 63% of the market. Cloud computing, the current revenue engine. Market share dynamics. Amazon Web Services maintains its position as the dominant cloud infrastructure leader, with 30% global market share in Q2 2025, generating $30.9 billion in quarterly revenue. However, AWS's 17.5% year-over-year growth rate lags significantly behind its primary competitors, raising concerns about market share erosion. Microsoft Azure holds 20% of the global cloud market, with $29.9 billion in quarterly revenue, posting a robust 39% year-over-year growth rate that significantly outpaces AWS. Azure's momentum has been driven by early infrastructure investments supporting OpenAI and the company's aggressive expansion of AI-specific cloud services. Google Cloud Platform captured 13% market share, with $13.6 billion in revenue and a 32% growth rate, representing the fastest acceleration among the Big Three and demonstrating the company's success in closing the gap with its larger rivals. Together, these three providers control approximately 63% of the global cloud infrastructure market, with their combined annual run rate now approaching $400 billion. Azure's AI-driven transformation. Microsoft's Azure cloud business has become the clearest success story in translating AI investments into revenue growth. The company disclosed that Azure sales surpassed $75 billion on an annual basis for the first time in its fiscal fourth quarter of 2025, exceeding analyst expectations of $74.62 billion. Azure revenue jumped 39% in the June quarter, substantially above the analyst consensus estimate of 34.75%. Critically, Microsoft estimates that AI services contributed approximately 19% of Azure's growth in recent quarters. exceeding $3 billion in AI-specific revenue. The company has taken AI infrastructure market share every quarter in 2025, benefiting from its exclusive access to OpenAI's technology and the rapid rollout of AI products such as the M365 Copilot Assistant for enterprises. Looking ahead, some analysts anticipate Azure could achieve 40% year-over-year growth in the September quarter, above the company's guidance of 37%. This growth trajectory, if sustained, would represent a remarkable achievement for a business already generating more than $80 billion annually, and would go far in justifying Microsoft's massive infrastructure investments. Earnings expectations and market sentiment. The Magnificent Seven growth narrative. For the third quarter of 2025, analysts project that the Magnificent Seven companies will collectively report earnings growth of approximately 14.9% year-over-year, more than double the 6.7% growth rate expected from the remaining 493 companies in the S&P 500. This substantial gap underscores the extent to which these tech giants continue to drive overall market performance, even as their growth rates moderate from recent peaks. Looking forward, the Magnificent Seven's earnings growth is expected to stabilize around 15% through the first quarter of 2026, while growth for the rest of the index is forecast to accelerate to approximately 11.6% by the third quarter of next year. This convergence suggests that the exceptional outperformance that characterized 2023 and 2024, when AI-related stocks accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth, may be moderating. For 2025 as a whole, the Magnificent Seven are expected to post 18.0% earnings growth versus 10.8% for the S&P 493, with 2026 estimates painting a similar picture at 17.1% versus 12.9%. While this continued outperformance remains impressive, the narrowing gap raises questions about whether current valuations adequately reflect this deceleration. Company-specific forecasts. Microsoft is expected to report third-quarter revenue of $64.5 billion, with earnings per share of $3.11, representing solid year-over-year growth, driven primarily by Azure and AI services. Investors will focus intensely on management's commentary regarding the OpenAI partnership, particularly following the Memorandum of Understanding announced in September concerning OpenAI's transition from nonprofit to public benefit corporation status. Alphabet is forecast to report revenue approaching $99 billion for the quarter, with EPS of $2.28, representing approximately 8% growth. Bank of America analysts have raised their price target to $280, predicting strong search results and stable paid click growth that could mitigate risks associated with AI disruption. The company's cloud operations will be under particular scrutiny, with investors expecting enhancement in capacity to build on the acceleration noted in previous quarters. Meta is anticipated to report third-quarter revenue between $42 to $44 billion, significantly above earlier analyst consensus. The company's ability to balance massive AI infrastructure investments, including the Prometheus supercluster in Ohio and Hyperion cluster in Louisiana, with operational efficiency and margin maintenance, will be critical for investor confidence. Amazon faces expectations for Q3 revenue of $177.7 billion, with EPS of $1.57, representing approximately 11% and 10% year-over-year growth, respectively. AWS performance will be paramount, with analysts anticipating the Project Rainier data center initiative could help accelerate AWS growth to the 18 to 19% range, after the disappointing 17.5% growth rate in Q2. Apple is expected to report fiscal fourth quarter results with revenue of $102 billion and EPS of $1.77, benefiting from the initial weeks of iPhone 17 series sales. The company faces questions about whether its measured approach to AI, focusing on on-device processing through Apple Intelligence features rather than massive cloud infrastructure, can sustain its premium valuation amid intensifying competition. The bubble question: historical parallels and key differences. .com comparisons. The parallels between today's AI boom and the late 1990s .com bubble are impossible to ignore. 7 tech companies now account for more than a third of the S&P 500's value and trade at prices approximately 70 times higher than their earnings. This concentration and valuation expansion evoke memories of the .com era, when the technology sector's share of the S&P 500 reached 47% in 2000, having doubled from 23% in less than 2 years. However, critical differences distinguish the current environment from the .com crash. During the late 1990s, the unweighted average PE ratios across the 7 biggest tech companies reached 276x, with a median PE of 120 times. By contrast, today's Magnificent 7 trade at significantly lower multiples, with considerable heterogeneity, ranging from Alphabet's relatively modest PE of 28 to NVIDIA Corporation's elevated 54. More fundamentally, today's tech leaders generate massive cash flows and profits that were largely absent during the .com era. NVIDIA posted $35.1 billion in revenue for Q3 2025, with its data center segment contributing $30.8 billion, up 112% year over year. Amazon Web Services generates annual revenue exceeding $120 billion, with healthy operating margins, while Microsoft Azure surpasses $80 billion annually. Profitability versus speculation. Perhaps the most significant distinction between the current AI boom and the .com bubble lies in the fundamental business models. During the late 1990s, much of the telecom sector's $500 billion fiber optic build-out financed companies with little to no revenue, based purely on speculative projections of internet growth. These investments ultimately created massive overcapacity and collapsing prices, leading to widespread bankruptcies. Today's AI infrastructure investments, while enormous in absolute terms, are being made by companies with robust balance sheets and substantial existing revenue streams. Microsoft, Amazon, Alphabet, and Meta collectively generated approximately $1.1 trillion in revenue over the past year, with strong free cash flow supporting their capital expenditure programs. This financial strength provides a cushion that dot-com-era companies lacked. Nevertheless, concerning patterns are emerging. OpenAI expects to lose $8 billion in 2025, despite projecting $13 billion in revenue, with total losses anticipated to reach $44 billion through 2029, the first year the company projects profitability. The startup has entered into approximately $1 trillion in AI computing agreements, including a $60 billion annual arrangement with Oracle and a $10 billion allocation for custom semiconductor development, raising questions about the sustainability of this spending trajectory. The NVIDIA OpenAI loop, a troubling development reminiscent of dot-com-era excesses, involves circular transactions among AI companies. NVIDIA invested $100 billion in OpenAI, one of its primary customers for GPU chips. OpenAI has subsequently announced $300 billion in computing commitments with Oracle and partnerships with Amazon, Microsoft, and Google, all of which purchase NVIDIA hardware. These related party transactions create a feedback loop where the same companies are simultaneously funding and relying on each other, potentially distorting true market demand signals. As one engineering professor noted, when the same companies are both funding and relying on each other, decisions are no longer based on market demand or actual performance, but on reinforcing each other's growth expectations. Debt-financed infrastructure. Another concerning trend involves the increasing reliance on debt financing to support AI infrastructure investments, marking a departure from previous investment patterns. Meta recently secured a $27 billion financing agreement with private credit firm Blue Owl Capital to fund its largest data center. Oracle and other companies are discussing raising tens of billions in additional debt to finance data center expansion. This leverage amplifies both potential returns and risks. While the larger corporations remain well capitalized, special purpose entities being established off their balance sheets as companies like Oracle and CoreWeave create new structures for AI infrastructure, introduce bubblicious tendencies into the market. CoreWeave, an AI infrastructure startup backed by NVIDIA, saw its stock triple after its March listing before falling 30% over 2 days, following earnings that showed widening losses and infrastructure constraints. The profitability timeline challenge. When will AI investments pay off? The critical question facing investors is when and whether the massive AI infrastructure investments will generate returns that justify their cost. Bain & Company estimates that to justify current spending levels, AI data centers will need to generate $2 trillion in annual revenue by 2030. Yet, 3 years after ChatGPT's launch, AI revenues remain modest at an estimated $20 billion, requiring 100-fold growth to justify the expected build-out. Morgan Stanley Research estimates that AI-driven productivity could add 30 basis points to 2025 net margins for S&P 500 members, a meaningful but relatively modest contribution given the scale of investment. The firm projects that generative AI revenue could surpass $1 trillion by 2028 as software and internet companies successfully monetize their offerings. However, this timeline suggests several more years of heavy investment before profitability materializes. OpenAI's trajectory illustrates both the promise and challenge of AI monetization. The company crossed $12 billion in annual recurring revenue by mid-2025, with revenue doubling during the first 7 months of the year. Extraordinary growth by any measure. However, the company is burning approximately $700 million monthly on computing resources and expects to remain unprofitable until 2029. Industry-wide success rates. A widely cited MIT study earlier in 2025 found that of over 300 AI initiatives examined across industries, only about 5% yielded measurable benefits. The majority of AI projects faltered during the pilot phase due to poor integration into existing workflows and scalability issues. This low success rate suggests that while infrastructure providers may profit from selling computing capacity, many enterprises adopting AI may struggle to realize returns on their investments. Survey data indicates that while approximately 80% of businesses now utilize generative AI in some capacity, many report that it has not resulted in significant bottom-line impact. This disconnect between adoption and financial results presents a challenge for sustaining the current level of enthusiasm and investment in AI technologies. Market structure and systemic risks. Concentration risk. The extraordinary concentration of market value in a handful of technology companies creates systemic vulnerabilities. The Magnificent Seven now represent approximately 35% of the S&P 500's market capitalization, compared to just 15% for the comparable group of leading tech firms in 2000. This concentration means that any significant disappointment in earnings or guidance from these companies could have outsized impacts on overall market performance. Notably, the gap between the technology sector's share of market capitalization and its share of net income has widened significantly since late 2022. This divergence suggests that investors are pricing in substantial future earnings growth that may or may not materialize, leaving little margin for error. Capacity and obsolescence concerns. A fundamental risk inherent in the current AI infrastructure boom involves the rapid obsolescence of computing hardware. Unlike traditional infrastructure investments, such as highways or cellular towers, with multi-decade useful lifespans, AI computing infrastructure faces technology refresh cycles occurring every few years. Accelerated chip performance improvements, evolving AI model architectures requiring different hardware specifications, and competitive pressure driving continuous capability upgrades all contribute to limited revenue generation timelines relative to investment requirements. NVIDIA CEO Jensen Huang's announcement that the company will move to annual product refresh cycles for its AI chips underscores this accelerated obsolescence. While this pace of innovation drives continued sales for chip manufacturers, it creates uncertainty for infrastructure investors about the effective lifespan and return potential of their data center investments. Sector performance and investment implications. Winners and losers. The AI boom has created clear winners in the semiconductor and cloud infrastructure segments. NVIDIA posted record Q3 2025 revenue of $35.1 billion, with its data center segment generating $30.8 billion, up 112% year-over-year. The company's Hopper and Blackwell GPU architectures have become industry standards for AI training and inference workloads, with cloud service providers accounting for approximately 50% of data center revenue. Advanced Micro Devices. Advanced Micro Devices Incorporated has also benefited, with its stock surging 58.6% in recent months, as the company positions itself as an alternative to NVIDIA's dominant market position. However, AMD's ability to capture meaningful market share remains to be determined, given NVIDIA's substantial lead in both hardware performance and software ecosystem development. On the application layer, companies successfully monetizing AI through existing customer relationships are emerging as winners. Datadog, an observability platform that monitors AI operations in the cloud, has reported revenue growing more than 100% year-over-year from /board AI workloads as it charges customers each time a model generates content. This business model scales directly with AI usage growth, providing a clear path to profitability. The broadening opportunity set. As AI monetization expands beyond cloud infrastructure to enterprise software applications, a broader set of companies are finding success through hybrid pricing models. Platform companies with established customer bases possess competitive advantages over single-feature AI startups, as they can add AI capabilities to existing offerings without requiring customers to switch vendors or integrate new systems. ServiceNow Incorporated, for example, has seen its stock price reach new highs as the company integrates AI capabilities into its enterprise workflow platform. International Business Machines Corporation reported strong Q3 2025 results with 9% year-over-year revenue growth, driven by its automation and AI offerings, and an AI book of business now exceeding $9.5 billion. Analyst perspectives and forward outlook. Bullish arguments. Optimistic analysts argue that concerns about an AI bubble are premature, and that current valuations remain justified by strong fundamentals. Wedbush's Dan Ives, a prominent technology bull, asserts that approximately $3 trillion in AI investments may flow from businesses and government entities over the next 3 years, with many Wall Street investors still not fully recognizing the magnitude of this spending surge. Eric Schiffer from Patriarch Organization, which holds stakes in all Magnificent Seven companies, stated, "The risk-reward option may seem low right now, but that is not a good forward indicator. With greater spending and innovation in these models, adoption is going to grow. I don't think we are at a bubble stage yet." BlackRock's Larry Fink has defended the massive AI capital inflows, arguing that this investment is crucial for the U.S. to maintain its leadership in AI technology. He notes that investing in AI entails more than just GPUs and chips, encompassing infrastructure like HVAC systems and power grids, and anticipates that while some investments might fail, major players like Meta, Microsoft, and Alphabet are well positioned for success. Cautionary voices. Skeptics point to several warning signs, suggesting the AI boom may be approaching bubble territory. Jared Bernstein, former chair of the Biden Council of Economic Advisors, argues that soaring asset prices and extreme valuations indicate a likely AI bubble, noting the significant disparity between investment levels and realistic profit expectations. He highlights that despite impressive spending by the Magnificent Seven, much of their profits still stem from other sectors such as advertising and cloud services rather than AI specifically. The International Monetary Fund's chief economist cautioned at the organization's recent annual meeting that the current boom in AI investments bears similarities to the dot-com bubble of the 1990s. IMF Managing Director Kristalina Georgieva has noted a rise in indicators of financial instability, advising investors to prepare for potential challenges ahead. Business professor Eric Gordon from the University of Michigan has called the AI boom an order of magnitude overvaluation bubble, arguing that the financial fallout from an AI crash would be much greater than the dot-com bust due to significantly higher absolute valuations. He notes that CoreWeave's recent market cap decline of $23 billion demonstrates how more investors will suffer than suffered in the dot-com crash, and their suffering will be more painful. Regulatory and geopolitical factors. Antitrust scrutiny. Alphabet has recently benefited from a favorable resolution of the Department of Justice's antitrust case, which has served as a positive catalyst for the stock. However, ongoing regulatory scrutiny of big tech companies remains a persistent concern. The concentration of market power among a small number of AI infrastructure providers could invite increased regulatory attention, particularly if these companies are perceived as leveraging their dominant positions to exclude competitors. The European Union has already demonstrated willingness to regulate tech giants aggressively, with the European Commission fining Apple €1.8 billion in 2024 for anti-competitive practices related to its App Store. Similar regulatory actions could constrain the ability of U.S. tech companies to fully monetize their AI investments or force structural changes to their business models. Trade and geopolitical tensions. Geopolitical factors pose significant risks to AI infrastructure investments, particularly given the concentration of semiconductor manufacturing in geopolitically sensitive regions. NVIDIA and other chip companies face ongoing challenges related to U.S. export restrictions on AI chips to China, which limit their addressable market. Taiwan's central role in advanced semiconductor manufacturing creates supply chain vulnerabilities, as escalating tensions between China and Taiwan could disrupt production of the most advanced AI chips. Trade policies have already impacted technology companies' operations and profitability. Apple reported $800 million in costs related to tariffs in its fiscal Q3 2025, with the company anticipating a $1.1 billion impact in the subsequent quarter if tariff regulations remained unchanged. These additional costs compress margins and reduce the funds available for AI research and development investments. Strategic implications and conclusions. The path forward. As the 5 tech giants report earnings this week, they face the challenge of demonstrating that their massive AI infrastructure investments are beginning to generate tangible returns while maintaining investor confidence in the long-term opportunity. Microsoft's ability to show continued Azure growth above 35%, Meta's success in balancing infrastructure spending with operational efficiency, Alphabet's cloud acceleration, Amazon's AWS rebound, and Apple's iPhone sales momentum will all contribute to market sentiment regarding the sustainability of the AI boom. The narrowing growth gap between the Magnificent Seven and the rest of the S&P 500 suggests a potential broadening of market leadership in the coming quarters. If earnings growth for the tech giants continues to decelerate while other sectors accelerate, investors may begin rotating capital away from the mega-cap tech stocks that have driven market returns for the past 3 years. This rotation could be healthy for overall market structure, reducing concentration risk, but would represent a significant shift from recent patterns. Risk-reward assessment. The current environment presents a complex risk-reward calculus for investors. On one hand, the Magnificent Seven companies possess strong competitive moats, generate massive cash flows, maintain healthy balance sheets, and are investing in what is widely recognized as a transformative technology with legitimate long-term potential. Their dominant positions in cloud infrastructure, search, social media, e-commerce, and consumer electronics provide multiple revenue streams that cushion the impact of AI investment risks. On the other hand, valuations leave little room for disappointment. Growth rates are decelerating. AI profitability timelines remain uncertain. Circular transactions and leveraged financing introduce systemic risks. And the rapid obsolescence of AI hardware creates ongoing capital requirements. The concentration of market value in these companies amplifies the potential impact of any significant disappointment in earnings or guidance. Final perspective. Whether the AI boom represents sustainable growth or a dangerous bubble may not be a binary question. Elements of both genuine technological transformation and speculative excess appear to coexist in the current market. The infrastructure being built will likely prove valuable over time. As AI continues to integrate into business processes and consumer applications, however, the pace and magnitude of returns may fall short of the expectations embedded in current valuations, particularly in the near term. The most prudent approach for investors may involve distinguishing between the leaders, companies with established revenue streams, proven ability to monetize technology investments, and strong balance sheets, and the more speculative plays financing growth primarily through debt or venture capital. As Sam Altman himself warned, people will overinvest and lose money. during this phase of the AI boom, though he expressed confidence that OpenAI would not be among the casualties. This week's earnings reports will provide critical data points for assessing whether big tech's $400 billion AI investment gamble is paying off, or whether investors are pouring capital into an infrastructure build-out that may take years to generate adequate returns. The answers to these questions will shape market dynamics and investment strategies for the remainder of 2025 and beyond. Debt financing for AI infrastructure, big tech's $500 billion bet on the future. The artificial intelligence boom has entered a new and decisive phase in 2025, marked by an unprecedented surge in debt financing for data center infrastructure. Meta Platforms' recent $27 billion private credit arrangement for its Hyperion data center in Louisiana represents not just the largest private debt deal ever executed, but a fundamental transformation in how the technology industry funds its most ambitious projects. This shift from equity-based financing to debt-backed infrastructure development signals both extraordinary confidence in AI's trajectory and introduces novel risks that could reshape the competitive landscape of the entire sector. As big tech companies collectively commit over $400 billion in capital expenditures for 2025, with an additional $113 billion raised through debt markets, the industry faces a critical inflection point. The massive scale of these investments, combined with evolving financing structures that increasingly leverage private credit markets, raises profound questions about sustainability, returns, and the potential for overcapacity. This comprehensive analysis examines the mechanics of this debt-fueled build-out, evaluates the strategic rationale behind these financing decisions, assesses the risks embedded in current market structures, and explores what this transformation means for investors, policymakers, and the future of artificial intelligence infrastructure. Meta Platforms' partnership with Blue Owl Capital to finance the Hyperion Data Center campus represents the most sophisticated example of the new AI infrastructure financing model. Announced in October 2025, the deal structured $27 billion in debt and $2.5 billion in equity through a special purpose vehicle, with Blue Owl managed funds acquiring an 80% ownership stake, while Meta retained 20% and operational control. This arrangement allows Meta to develop one of the world's largest data center campuses, spanning 4 million square feet, with 2 to 5 gigawatts of power capacity in Richland Parish, Louisiana, without placing the massive debt burden directly on its corporate balance sheet. The financing was orchestrated by, which arranged the $27 billion debt component and facilitated the equity investment. Pacific Investment Management Company acquired approximately $18 billion of the bonds, while BlackRock purchased over $3 billion, demonstrating the strong institutional appetite for AI-linked infrastructure securities. The debt was priced at an attractive yield of approximately 6.58% at debt financing for AI infrastructure, big tech's $500 billion bet on the future. The Meta Blue Owl deal. Blueprint for a new financing paradigm. Structure and mechanics of the Hyperion transaction. Issuance roughly 225 basis points over treasuries, despite receiving an investment-grade A+ rating from S&P Global Ratings. This spread, approximately double that of Meta's own corporate bonds, reflects both the project-specific risks and the premium demanded by private credit investors. The transaction's most innovative feature is the residual value guarantee, RVG, that Meta provided to the joint venture. Under this guarantee, Meta commits that the Hyperion property will maintain a minimum value for the first 16 years of the lease. If Meta terminates the lease early and the market value falls below the guaranteed amount, the company must compensate the joint venture for the difference. According to S&P Global, this guarantee was the linchpin that secured the A+ credit rating, as it effectively transfers technology obsolescence risk back to Meta, while providing bondholders with credit protection backed by the tech giant's financial strength. The financial engineering behind the Hyperion deal offers Meta several strategic advantages that illuminate why this model is becoming increasingly attractive to hyperscalers. By retaining only 20% equity while maintaining operational control through long-term lease agreements, Meta converts what would traditionally be capital expenditure into operational expenditure. The company received a $3 billion cash distribution from the joint venture upon closing, providing immediate liquidity, while the 4-year initial lease term, with extension options, offers flexibility to adapt to changing technology landscapes. This structure preserves Meta's balance sheet capacity at a time when the company is already committing $60 to $65 billion in capital expenditures for 2025, with projections suggesting AI-related spending could reach hundreds of billions through 2028. For a company facing intense pressure to demonstrate returns on its AI investments while maintaining financial flexibility, the off-balance sheet treatment provides crucial breathing room. Meta Chief Financial Officer Susan Lee characterized the partnership as a bold step forward, combining Meta's deep expertise in building and operating world-class data centers with Blue Owl's strength in infrastructure investment. The market's enthusiastic reception of the Hyperion bonds validates the appeal of AI infrastructure as an asset class. Within days of issuance, the bonds began trading at premiums exceeding 110 cents on the dollar, generating approximately $2 billion in paper profits for PIMCO, which had initially held roughly $18 billion of the securities. The firm quickly sold more than $1 billion to lock in gains for its client funds, demonstrating both the liquidity of these instruments and the robust demand from institutional investors seeking exposure to AI-driven infrastructure. BlackRock's investment through its exchange-traded funds, including actively managed high-yield ETFs, makes these AI infrastructure assets accessible to individual investors, further broadening the market. The participation of both traditional fixed-income giants like PIMCO and diversified asset managers like BlackRock signals that AI data center debt is transitioning from an off-balance sheet treatment and strategic advantages market, reception and immediate returns, niche private credit product, to a mainstream institutional asset class with significant secondary market depth. Big tech companies are investing over $400 billion in AI infrastructure in 2025, with Microsoft and Amazon leading the spending spree. The 4 major hyperscalers, Microsoft, Amazon, Alphabet, and Meta are collectively investing approximately $403 billion in capital expenditures during their respective 2025 fiscal years, with the vast majority dedicated to AI infrastructure. Microsoft leads with $120 billion focused on Azure AI infrastructure and global data center expansion, representing a 50% increase year over year. Amazon follows closely with $118 billion, up 42% from 2024, with CEO Andy Jassy describing AI infrastructure as a once-in-a-lifetime type of business opportunity. Alphabet has committed approximately $85 billion for 2025, a 63% increase driven by demand for Google Cloud's AI capabilities and development of its Gemini models. Meta raised the midpoint of its 2025 capital expenditure guidance to $69 billion, building on CEO Mark Zuckerberg's conviction that superintelligence will enhance every aspect of our operations. In stark contrast, Apple maintains a more conservative posture with only $11 billion in projected 2025 capital spending, barely a tenth of its competitors, relying instead on a hybrid model that balances internal development with third-party infrastructure partnerships. The accelerating debt financing trend across big tech, scale and composition of 2025 AI capital expenditures. This spending surge represents a fundamental escalation in the competitive dynamics of AI infrastructure. Estimates that an additional $2.9 trillion in AI infrastructure spending will occur between 2025 and 2028, potentially adding 0.5% to U.S. economic growth over the next 2 years. Capital expenditure plans reported by S&P 500 companies have ballooned to $1.2 trillion in 2025, the highest since Tripadvisor Research began tracking in 2002, with AI-related investments driving much of this growth. A critical transformation is occurring in how these investments are funded. Over the past 3 years, most capital expenditures came from cash reserves sitting on tech companies' balance sheets. However, Goldman Sachs, the Goldman Sachs Group Inc. analysts note that AI-related issuers have accounted for $141 billion in corporate credit issuance in 2025 to date, eclipsing the full year 2024 gross supply of $127 billion. This represents a 70% increase from 2023 levels and marks a fundamental shift in the funding mix beyond cash to increasingly leveraged debt markets. Goldman Sachs credit strategist Lotfi Karui observed that the shifting funding mix of CapEx beyond cash is worth monitoring, noting that while not yet a cause for alarm, given the high cash flow generation and low leverage among large tech companies, the trend will marginally reduce the quality of corporate credit. The observation adds to growing discussions on Wall Street about corporate debt quality, following recent bankruptcies in the auto lending sector, where companies issued excessive debt to lenders who believed the loans were safe. Citigroup analysts projected in September 2025 that robust AI demand would drive hyperscalers to spend $490 billion on infrastructure in 2026, approximately $70 billion more than previously forecast, with an increasing proportion financed through debt rather than operational cash flow. This shift introduces new vulnerabilities, including potential defaults and interest rate sensitivity that were largely absent when investments were funded from cash reserves. The pivot from cash flow to debt financing. AI infrastructure financing increasingly relies on debt, with over $113 billion in major debt deals closed or announced in 2025. Led by Oracle's $38 billion Stargate project. His involvement in AI infrastructure financing represents perhaps the most ambitious and risky bet in the sector. Banks, led by JP Morgan Chase and Mitsubishi UFJ Financial Group, prepared to launch a $38 billion debt offering in late October 2025 to fund data centers tied to Oracle, marking the largest financing deal for AI infrastructure to reach the market. The package is split into two separate senior secured credit facilities. $23.25 billion for a data center in Texas and $14.75 billion for a project in Wisconsin. These facilities, both with 4-year maturities and 2 one-year extension options, are priced at approximately 2.5 percentage points over benchmark rates, translating to interest rates between 6.5% and 7%. Vantage Data Centers is constructing both facilities, which Oracle will ultimately use to host OpenAI's infrastructure as part of the broader Stargate project. Oracle's $500 billion commitment to AI infrastructure, developed in partnership with OpenAI. The Stargate initiative has already generated extraordinary market reactions. Oracle's stock surged over 40% in September 2025, after the company disclosed it had added $317 billion in future contract revenue, with a substantial portion originating from a 5-year, $300 billion deal with OpenAI, under which Oracle will build AI computing infrastructure and lease it to the ChatGPT maker. However, this dependency on a single customer that won't achieve profitability, Oracle's record-breaking $38 billion debt package, the Stargate initiative, and OpenAI dependency until 2029, according to OpenAI CEO Sam Altman, has raised concerns among investors and credit rating agencies. Moody's Ratings flagged significant risks in Oracle's AI data center strategy, pointing to the enormous costs of equipment, land, and electricity required for these projects. The rating agency noted that whether these will be financed through traditional debt, leases, or highly engineered financing vehicles, the overall growth in balance sheet obligations will also be extremely large. In July 2025, 2 months before the OpenAI deal was announced, Moody's assigned Oracle a negative credit outlook, signaling concern about the company's financial trajectory. D.A. Davidson analyst Gil Luria warned that Oracle faces a precarious position, estimating the company would need to generate over $300 billion in annual revenue by 2030 to justify the spending implied in its Oracle deal, a monumental leap from OpenAI's current revenue run rate of approximately $12 billion. Luria noted that a vast majority of Oracle's data center capacity is now promised to one customer, OpenAI, who itself does not have the capital to afford its many obligations. Oracle's existing debt burden compounds these concerns. As of August 2025, the company carried approximately $82 billion in long-term debt, with a debt-to-equity ratio of roughly 450%, dramatically higher than Alphabet's 11.5% or Microsoft's 33%. KeyBank Capital Markets estimates Oracle may need to borrow an additional $25 billion annually over the next 4 years to fulfill its commitments under the OpenAI arrangement. In September 2025, Oracle added $18 billion in corporate bond debt specifically for its AI data center build-out, further increasing its leverage. The Oracle-OpenAI relationship exemplifies what critics describe as circular deals that have become increasingly common in AI infrastructure financing. OpenAI itself lacks the capital to pay Oracle for the full $300 billion in services over 5 years, necessitating that OpenAI raise substantial additional capital and debt. The AI startup is on track to lose approximately $9 billion in 2025, with losses projected to rise to $47 billion by 2028, according to Bloomberg estimates, while generating revenue of only $15 to $20 billion in 2025. To address this funding gap, OpenAI has structured complex financing arrangements, including a potential $100 billion investment from NVIDIA, structured as $10 billion for each gigawatt of power capacity OpenAI brings online, alongside partnerships with AMD that could make OpenAI one of the chip maker's largest shareholders. Dylan Patel from SemiAnalysis noted in a recent podcast that OpenAI and Anthropic together account for approximately 1/3 of all NVIDIA GPU purchases, underscoring the concentration risk in the ecosystem. This circular structure, where NVIDIA invests in OpenAI, which buys NVIDIA chips to build infrastructure leased from Oracle, which in turn purchases more NVIDIA chips, creates what some analysts warn is hidden fragility that misleads investors, creditors, and regulators by credit risk and Moody's warning happening, financing concern, allowing the same capital to appear multiple times on different balance sheets. However, Citigroup analysts argue that a crucial difference from the 1990s telecom bubble exists. The crucial difference, in our opinion, lies in the off-ramp created by the increasing external demand for AI services driven by enterprise adoption. Private credit has rapidly become the dominant funding source for AI infrastructure, with quarterly funding running at approximately $50 billion at minimum over the past 3 quarters of 2025. UBS head of credit strategy Matthew Mish noted that even without factoring in the mega deals from Meta and Vantage, they are already providing 2 to 3 times what the public markets are providing. This transformation reflects private credit's ability to offer customized structuring, faster execution, and regulatory flexibility that traditional bank lending cannot match. Blue Owl Capital, with its $145 billion credit platform, sits at the center of this shift. The firm's Digital Infrastructure Fund 3, which targets AI and cloud infrastructure, reached full capitalization in 2025, reflecting institutional appetite for asset-backed, long-duration returns from AI-driven infrastructure. Beyond the Meta Hyperion deal, Blue Owl entered a second phase of a $15 billion joint venture with Crusoe and Primary Digital Infrastructure to fund a 1.2 gigawatt AI data center in Abilene, Texas, demonstrating the scalability of this financing model. U.S. data center financing reached approximately $60 billion in 2025, with private credit firms like Apollo, KKR, and Brookfield vying to replicate successful deal structures. KKR partnered with Energy Capital Partners to commit $50 billion by 2028, specifically for AI data centers and power infrastructure. Macquarie Asset Management, traditionally focused on transportation infrastructure like roads and airports, has entered the AI data center space with acquisitions including facilities in South Korea. The financial mechanics driving institutional investment in AI infrastructure debt are compelling. Data center asset-backed securities and commercial mortgage-backed securities currently offer a 100 to 150 basis point premium over corporate bonds issued by hyperscalers, driven by triple net lease structures and stable tenant cash flows. For insurance companies, pension funds, and sovereign wealth funds seeking long-duration, high-yield assets that match their liability profiles, AI data centers resemble infrastructure bonds more than technology risk. S&P Global's Ruth Yang, global head of private market analytics, explained that investors view these deals as very specific, almost project finance, rather than speculative technology bets. The due diligence conducted by sophisticated private credit firms provides additional comfort. When I speak with private credit firms, I find their funding is not done willy-nilly. They've put a lot of thought into this. The combination of investment-grade ratings, when structured with appropriate guarantees, physical collateral in the form of data center assets, and long-term private credit's emergence as AI infrastructure's backbone. The $50 billion quarterly funding machine, institutional investor appetite, and return profiles. Lease commitments from creditworthy tenants creates a risk-return profile that appeals to conservative institutional capital. However, the rapid growth in commercial mortgage-backed securities tied to AI infrastructure raises concerns about concentration risk. J.P. Morgan Chase estimated in August 2025 that CMBS backed by AI infrastructure had already reached $15.6 billion, up 30% from the full year 2024 total. Unlike corporate debt tied to diversified businesses with multiple revenue streams, these securities are collateralized solely by the payments generated by specific data center complexes, creating vulnerability if AI adoption proves slower than anticipated. CoreWeave, the AI cloud provider that transitioned from cryptocurrency mining to become a leading GPU infrastructure company, exemplifies both the opportunities and risks of debt-financed AI infrastructure. In July 2025, CoreWeave closed a $2.6 billion delayed draw term loan facility, DDTL 3.0, to support its long-term agreement with OpenAI, bringing its total debt and equity financing raised over 18 months to over $25 billion. The facility, orchestrated by MUFG as joint bookrunners with Goldman Sachs as joint lead arranger, was financed at SOFR plus 4%, reflecting CoreWeave's progress in reducing capital costs. The company's balance sheet reveals the financial intensity of this strategy. $11.2 billion in debt, with interest rates fluctuating between 7% and 15%, generating over $250 million in interest payments in a single quarter, against only $19 million in operating income. Approximately half of CoreWeave's assets consist of GPUs, which the company depreciates over 6 years, a schedule that critics argue overstates asset values given NVIDIA's accelerating product cycles. D.A. Davidson analyst Gil Luria bluntly characterized CoreWeave as a value-destructive entity. CoreWeave founder and Chief Development Officer Michael Intrater defends the debt strategy, arguing that each CoreWeave contract, averaging 4 years in length, factors in most of the costs associated with fulfilling it: GPUs, data center construction, and interest payments, along with depreciation and maintenance. Contracts are typically structured to yield approximately $2 in revenue for every dollar of debt to be repaid. However, J.P. Morgan forecasts suggest CoreWeave's debt could escalate to $30 billion within 2 years, raising questions about sustainability if AI demand softens. One of the most contentious debates in AI infrastructure financing centers on the appropriate depreciation schedule for GPU assets. NVIDIA CEO Jensen Huang's commitment to a 1-year product advancement cadence has fundamentally accelerated hardware obsolescence, with each generation promising 10 to 20 times improvements in tokens per watt, a pace that far exceeds traditional Moore's Law advancement. Between the Hopper H100, launched 2022, and Blackwell architecture 2024, NVIDIA drove costs down by this magnitude, while traditional semiconductor improvements would have achieved only 20% gains over the same period. CoreWeave's aggressive debt-fueled expansion, technology obsolescence, and GPU depreciation risks the accelerating chip upgrade cycle. This rapid advancement creates significant tension with depreciation schedules used by data center operators. Hyperscalers like Microsoft and Amazon typically employ 3 to 4 year depreciation cycles for GPUs. CoreWeave and some newer cloud providers use 6-year depreciation schedules. However, Jonathan Ross, CEO of Grok and one of the founders of Google TPUs, argues that companies using 3 to 5 year amortization cycles are fundamentally wrong, with Grok employing a 1-year cycle to reflect actual economic obsolescence. Nabius Group, a NASDAQ-listed AI cloud provider that secured a $19.4 billion deal with Microsoft in September 2025, disclosed in its 2024 Form 20-F that it depreciates GPU assets using a straight-line method over a 4-year useful life. During its Q1 2025 earnings call, management clarified the company now uses a full-year depreciation schedule, though it remains unclear whether this means newly acquired GPUs are fully depreciated within 1 year or retain a 4-year life, but are depreciated in full during the year of purchase. Even at the most generous estimate, Nebius likely depreciates GPU assets over an average of about 3 years, significantly shorter than CoreWeave's 6-year schedule. Actual secondary market pricing for GPUs provides insight into real-world obsolescence versus accounting depreciation. Current median prices as of October 2025 show that the A100, launched in 2020, trades at approximately $12,000. The H100, 2022, at $25,000, and the H200, 2024, at $33,000. Using a 5-year straight-line depreciation schedule, estimated book values would be approximately $3,000 for the A100, $10,000 for the H100, and $24,000 for the H200. This means the A100 trades at 4 times its depreciated book value, the H100 at 2.5 times, and the H200 at 1.4 times. This secondary market premium suggests that GPUs retain economic value beyond their depreciation schedules, with buyers pricing these assets based on continued cash flow generation rather than book value. The A100, launched 5 years ago and theoretically obsolete by bearish standards, still commands rental rates over $1 per hour as of October 2025. However, rental rate declines paint a more sobering picture. Amazon disclosed in June 2025 that it had slashed rental prices on older generations of NVIDIA GPUs by as much as 45%. CoreWeave and Nebius currently offer H100 rentals at as low as $2 per hour, a 75% drop from peak prices of approximately $8 per hour 2 years earlier, and a 23% decline from just under a year ago. The gap between accounting depreciation and economic obsolescence creates material balance sheet risks. If book values assume 6 years of useful life, but market values drop 50% by year 3, companies face the prospect of impairment charges, one-time write-downs that can surprise investors and damage credibility. For CoreWeave, with approximately $5.6 billion in GPU assets on its balance sheet, half of its $11.2 billion total assets, a 30 to 40% impairment would wipe out most of the company's equity value and potentially trigger debt covenant violations. The debt collateral structure compounds these risks. Many GPU financing deals structure the hardware itself as collateral, with special purpose vehicles, SPVs, issuing debt secured by the DOT. Secondary market evidence and residual values, balance sheet implications, and impairment risk, GPU assets. If technological advancement accelerates obsolescence faster than anticipated, as NVIDIA's 1-year cycle suggests, the collateral value supporting these loans erodes rapidly. Meta's decision to depreciate H100 GPUs at an annualized failure rate of approximately 9% suggests more than 1 in 4 will be inoperable after 3 years, further pressuring residual values. Harris Kupperman, an investor who has analyzed the economics of AI data centers extensively, calculates that facilities coming online in 2025 will face roughly $40 billion in annual depreciation costs, primarily from expensive GPUs and specialized equipment, while generating only $15–20 billion in revenue at current usage rates. Even accounting for growth, these facilities would need to see tenfold increases in utilization or pricing just to break even on a fully loaded cost basis. A fundamental tension exists between the massive capital being deployed into AI infrastructure and the still nascent revenue streams from AI applications. MIT research that studied 300 public AI initiatives found that 95% of organizations achieved zero return on enterprise investments of $30 to $40 billion into generative AI. This finding, published in August 2025, rattled tech investors who had tolerated record AI spending from major companies based on expectations of eventual record returns. Aditya Chalapalli, research contributor to Project Nanda at MIT, noted that even firms now using AI are not seeing widespread disruption. OpenAI, despite attracting approximately 700 million weekly active users, generates subscription and API revenue, running at only a $12 to $13 billion annual pace, modest compared to the staggering infrastructure costs required to serve such scale. Analysts estimate OpenAI burns about $8 billion annually, with compute expenses representing the majority of operating costs, and profitability unlikely until later this decade. Bloomberg also reported that xAI, Elon Musk's AI venture, is losing approximately $1 billion per month. The defensive nature of current AI investment creates particularly challenging monetization dynamics. When tech giants can afford to offer AI features as loss leaders subsidized by profitable core businesses, standalone AI companies struggle to charge premium prices for similar capabilities. UC Berkeley economist Brad DeLong argues that much current AI spending represents defensive insurance rather than profit-seeking investment, with companies feeling compelled to build AI capabilities to avoid being left behind, even when immediate returns are unclear. Research estimates that AI-driven productivity could add 30 basis points to 2025 net margins for S&P 500 members, with software vendors able to monetize the productivity gains Gen AI products bring to end customers. Companies discussing AI adoption were rewarded in fourth quarter 2024 earnings, with AI adopters already outperforming the broader market, according to U.S. equity strategist Andrew Packer. The CEO, monetization challenges and return on investment concerns, the revenue gap and enterprise adoption timeline. The 2026 to 2030 commercial testing period of a large transportation tech company attending S2025 Technology, Media, and Telecom Conference expressed newfound optimism. Getting AI to work at an enterprise scale is very hard, but I'm finally seeing some signs of it. Over the next 2 to 3 years, this is the planet. We're going to see hundreds of millions of dollars of benefits. However, the period from 2026 to 2030 represents the crucial testing ground for AI's commercial viability. By then, today's massive infrastructure investments will be largely complete and operational, creating intense pressure to monetize these assets. Enterprise adoption represents the most immediate opportunity, with companies beginning to pay for AI-powered productivity tools and early adopters reporting measurable time savings in coding, document analysis, and content creation. Cloud providers are particularly well-positioned to capture medium-term returns through usage-based pricing as enterprises increase AI workloads. Yet significant risks of overcapacity loom. If AI application rollouts prove slower than expected, the industry could face a glut of underutilized computing power by 2027. AI technologist Eric Koziol warns that translating AI capabilities into fully automated business processes is far more complex than many assume, with AI typically handling 80% of a task effectively. But the remaining 20%, edge cases, integration challenges, quality control, still requiring human oversight. This last-mile problem could substantially delay the timeline for realizing returns on infrastructure investments. Bain & Company's 6th Annual Global Technology Report, released in September 2025, projects that $2 trillion in new annual revenue is needed to fund computing power required to meet anticipated AI demand by 2030. However, even with AI-related savings, the world is still $800 billion short of the revenue required to profitably fund the data centers of 2030. By that year, global incremental AI compute requirements could reach 200 gigawatts, with the US accounting for half of the power. Even if companies in the US shifted all of their on-premise IT budgets to cloud and reinvested the savings from applying AI in sales, marketing, customer support, and R&D into capital spending on new data centers, the amount would still fall short of the revenue needed to fund full investment, as AI's compute demand grows at more than twice the rate of Moore's Law. A separate Bain report warns that AI firms' revenue could fall $800 billion short of what's needed to fund computing power by 2030. This revenue gap becomes particularly acute when viewed through the lens of debt servicing requirements, with interest rates on AI infrastructure debt ranging from 6 to 7% for investment-grade paper, to 10 to 15% for more speculative credits. The annual debt service burden on the $113 billion in major deals cracked for 2025 alone could exceed $8 to $10 billion, as these debt packages multiply, with projections suggesting private credit deployment of $800 billion between 2025 and 2028. The aggregate interest expense could reach $50 to $60 billion annually by the end of the decade. This burden must be serviced from AI application revenues that remain in their infancy. Bain's $800 billion revenue shortfall warning. Analysts and investors are drawing increasing comparisons between the current AI infrastructure build-out and the telecommunications overexpansion of the late 1990s and early 2000s. Daniel Sorid, head of U.S. investment-grade credit strategy at Citigroup, noted that it's natural for credit investors to think back to the early 2000s when telecom companies arguably overbuilt and overborrowed, and we saw some significant write-downs on those assets. The telecom bubble saw equipment manufacturers fund and invest in their own clients, intensifying speculative behavior that ultimately led to massive bankruptcies and creditor losses exceeding $2 trillion. However, Important distinctions exist between the current AI boom and the 1990s telecom cycle. As a percentage of GDP, spending on communications equipment, computers and peripheral equipment, and data center structures remains well below the peak levels recorded in the late 1990s. This suggests the current AI infrastructure build-out, while aggressive, has not yet reached the extreme overinvestment levels that characterized the telecom bubble. Additionally, the AI infrastructure being built serves real, growing demand from enterprises seeking to deploy AI capabilities. Whereas much telecom capacity in the 1990s was built on speculation about future internet adoption that proved overly optimistic in its timeline. OpenAI CEO Sam Altman himself has drawn parallels to the dot-com bubble, cautioning that someone's gonna get burned there. Particularly given that 95% of generative AI projects reportedly don't deliver any profit, according to MIT research. The concentration of capital in a small number of players, with OpenAI and Anthropic accounting for 1/3 of NVIDIA GPU purchases, creates systemic fragility reminiscent of the concentrated bets that characterized earlier technology bubbles. A critical difference between equity-funded bubbles and debt-funded build-outs lies in the systemic risk transmission mechanism. Research from the Center for Economic Policy Research argues that innovation-driven bubbles can yield real benefits when financed by equity rather than debt, as equity investors who face losses in a bust bear the consequences directly without threatening the broader financial system. The dot-com bubble, largely equity-financed, caused significant wealth destruction for investors, but did not trigger a financial crisis. In contrast, when bank lending and debt financing dominate the funding cycle, bubbles pose genuine systemic risks. The 2008 financial crisis demonstrated how debt-financed real estate speculation could threaten the entire global financial system when borrowers defaulted and lenders faced insolvency. While AI infrastructure debt currently represents a small fraction of total bank lending, the rapid growth trajectory and increasing involvement of commercial banks in these deals raises concern about escalating exposure. The rise of payment-in-kind PIK loans to tech-oriented borrowers signals emerging stress. UBS noted that PIK income in business development companies, BDCs, reached the highest level since 2020 in the second quarter of 2025, climbing to 6%. PIK structures, where interest is paid, systemic risks and bubble concerns, historical parallels to the telecom boom. The leverage and liquidity dimension in additional debt rather than cash typically emerge when borrowers lack sufficient cash flow to service debt through conventional payments, a warning sign of financial strain. The circular funding structures that have emerged in AI infrastructure financing create what Paul Kedrowski, venture capitalist and MIT research fellow, describes as concentration of who ultimately holds the risk: big tech, the lenders or the investors in funds that own the loans. Special purpose vehicles obscure the ultimate risk-bearing entities, making it difficult for regulators and investors to assess true exposure levels. When the same capital appears multiple times on different balance sheets, NVIDIA investing in OpenAI which buys NVIDIA chips through contracts with Oracle, which in turn purchases NVIDIA GPUs. The system contains hidden leverage that could amplify losses in a downturn. S&P Global's Ruth Yang points to another dimension of uncertainty. Data center deals are 20 to 30-year tenor fundings for a technology that we don't even know what they will look like in 5 years. She notes that we are conservative in our assessment of forward cash flows because we don't know what they will look like. There's no historical basis. This fundamental uncertainty about future cash flows, combined with 20 to 30-year financing horizons, creates asymmetric risk where lenders assume technology and demand risk far beyond any reasonable forecasting horizon. The authorities face a delicate balancing act in addressing these emerging risks. Research from the Center for Economic Policy Research argues that while the primary obligation of regulators is not to suppress bubbles which can yield innovation benefits, they must identify excesses in the financial system and act before systemic risks materialize. The failure to do so in the years before the 2008 global financial crisis contributed to the severity of the subsequent collapse. As long as funding for AI data centers comes primarily from equity investors and well-capitalized private credit funds with sophisticated institutional limited partners, systemic concerns remain limited. However, once traditional bank lending becomes a significant funding source, the AI bubble transitions from a matter for private investors to a genuine policy concern requiring regulatory intervention. The $38 billion Oracle-linked debt package with JP Morgan Chase, MUFG, Wells Fargo and Company, Goldman Sachs, and other major banks as lead arrangers suggests this transition may already be underway. The debt-financed AI infrastructure boom is fundamentally reshaping competitive dynamics in cloud computing. Microsoft's Azure reported 31% average quarterly growth in 2024, up from 28% in 2023, driven largely by enterprise AI offerings. In contrast, Google Cloud's slower growth in Q4 2024, attributed to compute capacity constraints, rattled investors and sent circular funding and hidden fragility, the role of regulatory oversight, strategic implications, and future outlook, the competitive reconfiguration of cloud markets. Alphabet stock lower. Both companies flagged capacity shortages as barriers to scaling AI customers, justifying the unprecedented 2025 capital expenditure surge. Amazon's AWS, Microsoft's Azure, and Alphabet's Google Cloud are projected to report significant growth in their cloud computing divisions for Q3 2025, despite capacity constraints limiting their ability to meet AI demand. The companies are expected to reaffirm capital expenditure plans, signaling continued aggressive investment, despite mounting pressure to demonstrate returns. BlackRock's entry into direct data center ownership through its AI infrastructure partnership with NVIDIA, Microsoft, and Abu Dhabi's MGX, which plans to acquire aligned data centers for $40 billion and deploy a total of $100 billion, including debt financing, represents a new category of mega capital participation that could further disrupt traditional hyperscaler dominance. Apple's conservative AI spending posture presents both risks and potential advantages. While the company generates far more in sales and profit from its capital outlays compared to rivals, and has avoided large layoffs through its lean employee base, it risks falling behind in AI capabilities. Late Thursday reports indicated Apple researchers are demoralized by limited access to training data due to privacy protections and the company's slow software update cadence compared to rivals who push updates frequently. Meta CEO Mark Zuckerberg is reportedly exploiting this discontent by poaching disaffected Apple AI engineers with pay packages running into the hundreds of millions of dollars. For private credit managers, AI infrastructure represents one of the most significant deployment opportunities in the sector's history. Blue Owl co-CEOs Doug Ostrover and Mark Lipschultz described the Meta Hyperion project as a bold undertaking that reflects the urgency and scale required for next-generation AI infrastructure. Mark Czar, co-president and global head of real assets at Blue Owl, stated, "The AI-driven demand for compute power highlights one of the most compelling investment opportunities our real assets platform has seen since our inception." The global data center market, valued at $177.76 billion in 2024, is projected to grow at a 31.6% compound annual rate to reach $933.76 billion by 2030, according to Markets and Markets. This growth trajectory suggests AI data centers are transitioning from IT facilities to 21st century core infrastructure assets, comparable to airports, ports, and roads in their economic importance. For institutional investors seeking stable, long-term cash flows from essential infrastructure, this asset class offers compelling characteristics. Physical assets with clear utility, long-term lease agreements with creditworthy counterparties, and participation in a transformative technology trend. However, successful deployment requires sophisticated risk management. Investors must prioritize lenders with strong underwriting discipline, diversification across geographies and technologies, and conservative assumptions about asset depreciation and technological obsolescence. The distinction between investment-grade structures with robust guarantees, like Meta's residual value guarantee, and more speculative credits relying solely on projected cash flows from unproven business models, will likely determine which investors realize attractive returns versus those who suffer losses when the inevitable shakeout occurs. The private credit opportunity and long-term infrastructure asset class. The geographic distribution of AI data center development is creating new competitive dynamics among states and regions. States like Louisiana, Texas, and Virginia are competing as AI infrastructure jurisdictions, with success hinging less on land availability and tax incentives, and more on power infrastructure, permitting speed, and regulatory stability. Meta's selection of Richland Parish, Louisiana, for its Hyperion facility, projected to create over 500 jobs once operational and requiring 2 to 5 gigawatts of power, illustrates how energy availability has become the primary constraint on AI infrastructure development. the power requirements for AI infrastructure pose extraordinary challenges. Estimates that between 2025 and 2028, $800 billion of private credit capital will be required to finance not just data centers, but also renewable power generation and fiber networking to support AI infrastructure. Utilities face their own borrowing requirements to build the electrical infrastructure needed to feed power-hungry data centers, with Citigroup analysts expressing concern about spending so much before AI projects have demonstrated long-term revenue generation ability. Policymakers must balance competing objectives, fostering innovation in transformative technologies, ensuring adequate infrastructure investment to maintain competitive advantages, protecting the stability of financial markets, and avoiding the creation of stranded assets if demand proves less robust than projected. The lesson from previous infrastructure build-outs, from railroads in the 19th century to fiber optic networks in the 1990s, is that overbuilding is often a feature rather than a bug of major technology transitions, with society ultimately benefiting from excess capacity even as investors suffer losses. Meta Platforms' $27 billion Hyperion deal represents far more than a singular financing transaction. It marks the emergence of a new paradigm for funding the physical infrastructure of artificial intelligence. The combination of off-balance sheet structures, private credit as the primary capital source, sophisticated risk-sharing through residual value guarantees, and institutional demand for AI-linked securities has created a replicable template that is rapidly being adopted across the industry. Oracle's $38 billion debt package, CoreWeave's aggressive leverage, and Blue Owl's multiple gigawatt-scale projects demonstrate that debt financing has transitioned from a supplementary funding source to the primary mechanism enabling the AI infrastructure boom. This transformation carries profound implications. For technology companies, debt financing provides a path to accelerate AI infrastructure development without exhausting balance sheet capacity or diluting shareholders, preserving financial flexibility while maintaining competitive positioning. For private credit managers and institutional investors, AI data centers offer exposure to a high-growth, asset-backed asset class, with attractive yields and the potential for long-term stable cash flows. For the broader economy, the willingness of capital markets to fund massive AI infrastructure investments could accelerate innovation and productivity gains that drive economic growth. Policy considerations and infrastructure development. Conclusion: a pivot point for AI infrastructure financing. Yet the risks embedded in this debt-fueled build-out are substantial and multifaceted. Technological obsolescence threatens to erode asset values faster than depreciation schedules anticipate, particularly given NVIDIA's commitment to annual product advancement cycles that deliver order-of-magnitude performance improvements. Monetization challenges persist, with the vast majority of AI pilots failing to deliver sustained value and a projected $800 billion revenue shortfall by 2030, according to Bain & Company analysis. circular financing structures create hidden leverage and concentration risks that obscure true exposure levels. The increasing involvement of traditional banks in mega deals shifts risk from private investors to institutions whose distress could have systemic implications. The period from 2026 to 2030 will determine whether this debt-financed infrastructure boom represents visionary capital allocation that positioned first movers to capture transformative AI revenues, or whether it becomes a cautionary tale of overbuilding, stranded assets, and investor losses reminiscent of earlier technology bubbles. The answer likely lies somewhere between these extremes, with some investments generating substantial returns, while others face impairments and restructurings. What is certain is that the scale of capital being deployed, over $500 billion annually, when combining equity capex and debt financing, ensures that AI infrastructure development will be a defining force in technology, finance, and economic growth for the remainder of this decade. See you in another day with tech news. Have a good night's rest. See you tomorrow.